Alright, guys, today we break down some powerful lessons inspired by Adam Khoo recent Black Friday webinar, focusing on how long-term investors identifying great companies when they buy their shares in the stocks, how much they allocate on every stocks, and the discipline needed to sell these stocks. So, if you've ever wondered why great businesses continue to grow despite recessions, elections, wars, and unfavorable global environments, and how disciplined investors navigate through these times, then we are here to break down every aspect of it. Okay, let us hear from Adam.
They are altogether 4 keys to successful investing. And I like to use this acronym WWHW. So what does the first W stand for? The first W is this. To be a successful investor, you must know exactly what to buy. You must know exactly what to buy. In the US market, there are over close to 5,000 companies you can buy. Or in the world, there's tens of thousands right now. Do you want to buy all the stocks? Do you want to buy all the stocks? No. Again, what did the research show you? 90% of all the, sorry, not 90%, 100% of all the profits came from what? 100% of all the profits in the long term came from how many percent? Came from only 3% of the stocks. Remember that? And 90% of all the profits come from less than 2% of the companies. So we only want to buy great businesses, the best of the best. We are not interested in buying average businesses. We're not interested in buying lousy businesses. We only want to buy great businesses. Now, you may ask, how do I know it's a great business? Okay, so later I'm going to show you, I've got a 7-step investment criteria for identifying great businesses. So for me, before I buy a stock of a business, it must pass my criteria. So I'm going to show you a lot of examples in a while. Okay. Now, so that's the first key. Number 2, once you know what to buy, you must know exactly when to buy. Why? Because listen carefully, a great business can be a lousy investment if you pay too high a price for the shares, if you buy it at the wrong time. But a great business can be a great investment if you can buy it for less than what it is worth. Okay, I repeat, a great business is a great investment if you can buy it for less than what it is worth. So in other words, we only want to buy great businesses when they are undervalued. When the share price is selling below the intrinsic value of the business. Now you may ask, how do I know what's the intrinsic value? How do I know what it's worth? Okay, coming, right? I'll come to that in a while. Now, this is no different from real estate. Let me ask you this question. Let's imagine that you want to buy an apartment and you found a beautiful apartment, great view, great location, beautiful furnishings, right? What do? You get a bank valuation. Now, the bank values the apartment at, say, $2 million. But the seller is asking for 2.5 million. And you got so excited by it because there's only one left. And you say, okay, I pay 2.5 million. Now, is that a good investment? No. Right? Because you paid $500,000 over valuation and it'll take you longer to eventually break even if you sell it. It's like people who bought Sentosa Cove in Singapore. After 20 years, they still lose money. Have you read about that? Because they overpay ridiculous price. Ridiculous price, right? But if, let's say the seller of the apartment was desperate. Let's say he's going through a divorce. His business went bankrupt and he has to quickly sell the apartment. And at that time, no one was there to buy. You're the only one there. And you said, okay, I tell you what, I buy your apartment for 1.5 million. And he says, he's desperate. He sells it to you. Now, is that a good deal? Yes, you bought it $500,000 below valuation, right? Okay. Question, is it easy to find those deals in the real estate market? Is it easy to find a desperate seller? No, it is very difficult, right? But you know what's the good news? The good news is that it is very easy in the stock market. Because in the stock market, there are times every year when investors panic because of all kinds of reasons, right? And when they panic, they are willing to throw their stock at 20, 30, 40, 50% discount. And if you know which are the great companies, the great apartments with the great view and the great location, and you can buy 20, 30% below valuation, you make a lot of money. Is that clear, everyone? Is that clear? So how have I made millions in the market? I make millions in the market by buying great companies when sellers are desperate. When people are panicking, they're desperate. We're gonna die! We're gonna die! And they sell their good company at 20, 30, 40% discount because they thought it's the end of the world. That's how I managed to buy Meta that time at 70% discount. I bought Google at 40% discount last year. I know many of you did at the same time, right? Because people thought, oh, ChatGPT is going to kill Google. Google's going to be broken up, or Google's going to die. Freaking idiots, right? If you analyze the business, you know that they're making more sales and profits every year. Their moat is getting stronger. So ignore the analysts, ignore the news, trust the numbers, trust the research, and take advantage of people's short-term panic and short-term mentality. Is that clear? Okay, so a lot on psychology that you're going to learn in the course. All right, next. The third key, once you know what to buy, you know when to buy. Number 3, you must know how many shares to buy. Very important. Okay, listen very carefully. No matter how great you think a stock is, do you put all your money in one stock? Do you ever put all your money in one business? No. Why? Because no matter how great a business is, shit can happen. Shit can happen that you can't always foresee. So always divide your capital into minimum what? Always divide your capital into minimum at least 8 to 10 great companies, right? At least 8 to 10 great companies, so that if one or two of them shit happens and the share price drops in the short term, it doesn't matter, right? Because the rest of the companies will go up and bring up your portfolio, right? So as you guys know, I bought Alibaba back in 2016, or was it 2017? Yeah, I've been holding Alibaba now for like 9 years, right? So I bought Alibaba, and I had no way to predict that Jack Ma would piss off Xi Jinping, right? And they cracked down on the tech companies, and my Alibaba dropped 60% in 2021. Could I predict it? There's no way I could predict it, right? But did it matter? It didn't matter, because in 2021, my portfolio still grew close to 30%. Because my Alibaba went down, but my other companies went up, right? And by the way, today, I'm still holding my Alibaba. I've not sold it yet, right? Because there's nothing wrong. It's still growing. It's still okay, right? Okay, so this is called portfolio allocation and diversification, where we'll go into in detail in the Whale Investor course. And you will see exactly how I do it every day in the Ultimate Investors Playbook subscription, okay? Finally, you must know when to sell. A lot of people, you know what's their problem? They say, Adam, I know what to buy. I know when to buy. I don't know when to sell. I don't know when to sell. You gotta know when to sell. Some people, you know what's their problem? They sell too early. Okay? They buy a stock, it goes up 20%, 30%, 50%. They take profit. And then the stock goes up 1,000%. They're not there. It's like when I bought NVIDIA at $15 in late 2022. Many people also bought NVIDIA. I bought Palantir at $9. Many people also did that. I shared it in my YouTube videos, right? But when NVIDIA from $15, it went to $30, people say, oh, it already doubled. It already went so high, it can't go higher. They sold all at $30, right? Now Nvidia went up to 200. Now it dropped to 180, but it's still up more than 10 times. Have I sold any Nvidia? No, because Nvidia is the most important company in the AI revolution. Because to build robots, to build robo-taxis, agentic AI, everything needs Nvidia. There's only one Nvidia. AMD is very far behind. Intel is very far behind. And that's why, even though my Nvidia grew 1000%, I ain't selling shit. I ain't selling a single share because I'm holding for the next 10, 20 years. There's a long runway. Same thing with Palantir. Now, I've sold quite a lot of Palantir because at the time when I sold it, it was way overpriced. But recently, Palantir's profits have caught up, so it is not that crazy expensive anymore. It's still not cheap. Palantir's still not cheap, but at least not super crazy expensive. So I'm not selling any more Palantir. In fact, I'm hoping it can drop a bit more. If Palantir can drop below 140, 130, I'm going to buy more Palantir, right? Because again, Palantir is the only pure play AI enterprise software company in the world. And there's no close competition, all right? So don't sell too early. If not, you will make peanuts. We call it kacang putih money in Asia. You will not make millions. You cannot sell too early. But at the same time, once it's way overpriced, once the company has a risk of being disrupted, you got to get out. Okay. Like Adobe. I used to own Adobe and I sold all my Adobe at a small profit. Okay. Because I think Adobe, if you watch the latest Nano Banana Pro from Google, you look at that, you will be very scared of owning Adobe. Because why would you need Adobe anymore when the latest AI Nano Banana can create everything you want in seconds? Okay, so the moment I feel that there's a chance that the company's business model, the mode could be disrupted, I'm out. Same thing with Duolingo, right? I bought Duolingo for a short profit. I made double my risk and I got out, right? So you have to know when to get out. Okay, so far, is it useful, everyone? Does this make sense? Okay, so let me go into greater detail, okay, on what to buy. So again, I only buy great businesses that pass my criteria. I've got 7 criteria for a great business. And less than 1% of companies pass my criteria. Less than 1%. So we only want to invest in the top 1%. So what are my criteria? Let me run through for those of you who are new to this. Write this down. Number 1, I only invest in businesses that have a track record, have a history of consistently increasing sales revenue, net income, and cash flow from operations. Okay? For at least 5 to 10 years. Please write this down. At least 5 to 10 years. So in other words, I want to make sure that the last 5 to 10 years, the business revenue is growing year after year after year after year. The profits are growing consistently, and the cash flow from operations is growing consistently. Why? Why is that important? Because if a business can grow their revenue, profits, and cash flow for at least 5 to 10 years, that means the business is predictable. Please write this down, everyone. Write this down. We want the business to be predictable. Number 2, it must be consistent. It must be consistent. Number 3, it must be resilient, which means that even in a recession, even in a pandemic, the business must be able to still grow their revenue and their profits. Now, can all businesses do this? Can all businesses pass the first criteria? No. In fact, I can tell you that less than 5% of businesses can pass my first criteria. So if you just apply my first criteria, it would eliminate 95% of all the companies. So let's look at a few examples, shall we? Now, I'm from Singapore. So people always like to ask me, what do you think about Singapore Airlines, SIA? Now, let me just say that I love Singapore Airlines as a customer. In fact, when I fly, I only fly on SIA, only SIA, because best customer service, best safety record. But will I ever buy shares of Singapore Airlines? Will I ever buy shares of SIA? No, never. Why? Because all airline businesses are not great businesses. It's not the fault of the management. It's the nature of the whole industry. Okay? Because they all fail the first criteria. They can't pass the first criteria. No airline can pass the first criteria. So let's take a look, shall we? Okay. So let's look at Singapore Airlines here. Now, by the way, this Singapore Airlines I'm looking at, oops, I just got logged out. Hold on. Let's log back in. Okay. So right now, as you know, Stock Oracle only shows US listed stocks. Okay. Next year, we'll be rolling out Singapore, Hong Kong, and China stocks on Stock Oracle next year, but now only US listed. So I'm going to show you Singapore Airlines, the one listed in the US market. So this is in US dollars. Okay. It's the Singapore Airlines shares listed in the US market. So if you take a look at Singapore Airlines, let's look at the financials. First thing you always do, look at the 5 to 10 year track record. Okay, so we can look at bar chart if you want. Okay, let's look at the bar chart. Now you can see the revenue. Okay, is the revenue growing consistently? Does it grow consistently in the long run? Well, it's not too bad. It's not too bad because you can see that, yeah, it's a bit cyclical. Now, of course, this was the COVID pandemic, but it's going up. So overall revenue does go up. So revenue is not bad. It's not bad. Okay. It does generally go up in the long term. But the problem is what? The problem is the what? Is the what? What's the problem? What's the problem? The problem is the net income is not consistent. Okay. So if you look at the net income, which is in green, what do you notice? You see the sales are so high, the profit is so low. Can you see the profit so low? And then here the profit dropped by half. Then the profit went up. Then the profit dropped by half. Then here lose money. Here lose a lot of money. Then here lose money. Then here make money. Make more money. Make the same money. And then here drop again. Can you see? So it is not consistent. So make more money, make less money, make more money, make less money. It is not consistent. Do you follow what I'm saying? The profit doesn't grow consistently. It is up and down, up and down. It is very, very inconsistent. And look at the free cash flow. Look at the free cash flow in green. Look at it. Negative, 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 negative. Very positive. Drop by half. Drop again. Drop again. Look at it. The free cash flow is going down. Okay? Now, what does it mean? That means, now, what's the problem with the airline business? Why is the airline business having negative free cash flow? A lot. Why is the cash flow not positive? Why is the profit so inconsistent? Why? What's the problem with the airline industry? Number one, is very competitive. There's too much competition and there's very high costs. There's high labor costs, high maintenance costs, high fuel costs, right? Now remember, what is a business? A business is a money-making machine. So if the business cannot make more money over time, it cannot be worth more over time. That's why the share price cannot go up over time. So if you look at the share price of Singapore Airlines, let's put it in the share price here. This is the US listed one. What do you notice in the long term? This is the last 10 years. What happened? If you hold Singapore Airlines for the long term, what happened? right? You can see 10 years ago, it was selling at $8. This is in US dollars, huh? In US dollars. You can convert to Sing, right? After 10 years of holding, is now at 490. Hold for 10 years and it's still down. Look at that. It's not the fault of the management. It's not their fault. It is all airlines are like that. It's all the same. Okay? So I avoid these kind of companies because it's very hard to make money. You understand? Now, on the other hand, what companies do I like? I like companies that have very low physical capital expenditure, all right, that are very scalable. So, example, let's look at MasterCard. Now, let's look at the difference of MasterCard. Let's look at financials here. Can you see this chart, everyone? Look at the revenue. Is the revenue growing consistently? Yes or no? Even in the pandemic, even in the greatest pandemic, their revenue only dropped a little bit. We call this resilient, recession-proof, pandemic-proof. That is what I want. And look at the net profit. Is the net profit very consistent? Is it growing consistently? Yes or no? Yes. So if the profit is growing consistently, you can easily project it to the future. If it's inconsistent, you can't do any reliable projections. And the profit margin is very high. The profit margin is like 30% profit margin. Whereas Singapore Airlines, the profit margin is only, I don't know, 5% or profit margin, right? And look at the free cash flow. The most important thing is the free cash flow. Look at the free cash flow. Is it growing consistently? Is it generating more and more cash every year? Yes, this is the kind of business that I find very, very, very predictable, very consistent, very resilient. So if you look at MasterCard, does the share price look like that? Does the share price look like that? No. If you put in MasterCard, what does the share price look like over the long term? All right. You can see the share price over the long run is on a very clear what? It's on a very clear uptrend. Okay, it's on a very clear uptrend. Now, again, does it go up in a straight line? Does the price go up every day, every week, every month, every year? No, it moves in wave patterns, right? Wave up, wave down, 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 wave up, wave down. It moves in these wave patterns. So it's like breathing pattern. Breathe out, breathe in, breathe out, breathe in, breathe out, breathe in. Now, no matter how strong you are, can you breathe out forever? No. You cannot breathe out forever. You run out of air, right? Eventually, you have to breathe in before you can breathe out again. Same thing with the stock market. It can't go up in a straight line. It goes through wave up, wave down, wave up, wave down, wave up, wave down. Now, as an intelligent investor, when do you want to buy? Do you want to buy after wave up or do you want to buy after wave down? Yes, you want to buy after wave down. So always wait for wave down, then you buy before the next wave up. Understand? Now, do we know exactly where's the bottom of the wave down? Can we predict the exact bottom? We can't always predict the exact bottom, right? But we don't need to buy at the bottom to make money. We don't need to buy at the bottom to make money. We just need to buy near the bottom, near the bottom. Okay? So let's say you buy here, and after you buy, it drops some more. Should you be very upset? After I bought it, drops some more. No, because you can't predict exactly where's the bottom. So that's why I teach my students, never buy at one go. If you want to buy 100 shares of a stock, buy over what? Buy over what? At least 4 to 5 tranches. So when it drops and is undervalued, buy 1/4 first. If it drops a bit more, buy another 1/4, right? Then let's say it rebounds, buy another 1/4. So you buy 1/4, 1/4, 1/4, 1/4, or 1/5, 1/5. You buy in 4 to 5 tranches. So your average price will be somewhere here. Is that clear? So if you buy somewhere here, over time, you buy somewhere here, you buy somewhere here, you buy somewhere here, you buy somewhere here. Over time, will you grow your portfolio? Yes or no? Yes? Oh, you love my crying. Great. I'll do more crying later. Okay. Sorry, where was I? MasterCard. Okay. Is this useful, everyone? So that is criteria number 1. Remember, I've got 7 criteria. I'm very strict. The stock must pass my 7 criteria before I'll buy it. Okay. Now, criteria number 2. Criteria number 2 is the most important criteria of all. This is the most important. So please write this down. Please listen carefully. I will only invest in a business that has a what? That has a sustainable competitive advantage that can protect it from competition, so that competitors cannot easily take away their customers. Competitors cannot easily take away their market share. So Warren Buffett, what does he call it? Warren Buffett calls it an economic moat. Now, what's a moat? In the old days, kings lived in castles. And how do they protect the castle from the invaders? They build a white moat around the castle. The moat is like this water barrier where they put crocodiles and whatever, right? So same thing in a business. When you buy a business, you have to make sure it's got a white moat with a lot of crocodiles. Okay? So the competitors cannot take away, the customer cannot take away your market share. So in other words, write this down, write this down, write this down. I only want to invest in businesses that have little or no competition. Have you written it down? I repeat, I only want to invest in businesses that have little or no competition. The competitors cannot easily disrupt their business. That is called a moat. Okay? So what gives a company a moat? What gives a company a strong moat? Number 1 is a very strong what? Brand. Okay? So there's a brand that people love, people are loyal to, and they got pricing power. That means even if the company raises price every year, people will still buy. Even if the price is higher than the competitors, people will still buy because of the loyalty to the brand. That gives a company a moat. Now, can you name me some companies where they can raise price every year and people still say, take my money, I still buy, even though it's more expensive than the competition? Apple, that's right. Apple sold out iPhone 17, right? Apple has one of the strongest brands in the world. Hermes, that's right. Hermes, Ferrari, correct. These are what we call strong brands that have got pricing power. I also like to buy companies that have a brand monopoly. Yeah, someone said Netflix, correct, Netflix, right? Now, LVMH, that's right. Now, what's a brand monopoly? It's one where the moment you mention a product or service, is a top of mind recall. It's the first thing that people think about. Okay, so let's play a game. Let's play a game. I'm going to mention a company. Sorry, I'm going to mention a product. And you tell me the first brand that you think of, right? So if I mention search, every day we have to search for information. When I mention search, what do you think about? Google. In fact, what do we say? We say Google this, Google that. It's become part of our vocabulary, right? Google has over 90% market share. And they own YouTube. They own Android. They own Chrome, right? Which are all leaders, okay? So, and they own Waymo, which is the leader in robo-taxi right now. So if you look at Google, again, if you look at it over the long run, okay, what do you notice? In the long run, it always goes up. Oops, sorry. Yeah. Let me show you. Okay, yeah. So in the long run, it always goes up because Google has no close competition. They have got no close competition. The competitors can't even smell their fart. Okay? What else? If I mention office software, when you think about office software, whether you work from home, you work in the office, that's right, Microsoft. So Microsoft, again, is a brand monopoly. There's no close competition. Long term, it always goes up. Okay? Now, wherever you are in the world, you're in Singapore, you're in Malaysia, you're in Europe, you're in the UK, you're in the US, early in the morning, late at night, you're hungry. But, restaurants are closed, but there's a fast food joint somewhere close by. What do you think about? McDonald's. That's right. So McDonald's is a brand monopoly in fast food. And that's why long term, you can see McDonald's always goes up. It always goes up. So make your life easy. Okay, I make my life easy. What do? I only like to buy what? I only like to buy brand monopolies. Okay, I only like to buy brand monopolies. So first thing that gives a company a moat is a strong brand, especially a brand monopoly. Next, you guys still with me? Okay. Next, I like to buy companies that have high customer switching cost. What does it mean? That means once the customer uses the product, it becomes very expensive, very inconvenient to have to switch to another brand because they are stuck there, all right? And they have to keep subscribing year after year after year after year. What companies lock in their customers for life? Very hard to switch. Software companies, right? Like Salesforce, like ServiceNow, like Constellation Software. That's right, cybersecurity companies like Palo Alto, like CrowdStrike, like Fortinet, consumer businesses like Apple. All these, they lock in the customer, right? That's why I own all these companies. I like companies that lock in the customer. Very, very good, right? Next, network effect. For example, in Asia, can you live without WhatsApp? In Asia, you cannot live without WhatsApp because to collaborate with family, with friends, with businesses, you have to be on WhatsApp. That's called a network effect. Okay. If you want to advertise online, you have no choice. You either advertise on Facebook, Instagram, YouTube, or Google, right? It's a network effect. You want to sell something online, you have to be on Amazon. You have to be on Alibaba. In China, you have to be on WeChat. You cannot live without WeChat, right? So these are what called network effect. You have to be in the network. You cannot get out of the network, right? Next, barriers to entry. So some companies have certain special intellectual property IP that their competitors are nowhere close to having the IP. So it creates a barrier to entry, right? Example, Palantir has a huge IP barrier to entry. What's the other one? ASML. ASML has a 90% market share on the equipment, the photo, what do you call it? The photo, suddenly I forgot. The equipment to make semiconductors, right? They need ASML machines to imprint the designs on the chip, right? And ASML is the only one with the IP to do it. No other company is close to ASML. Photolithography. Thank you guys. I'm getting a bit old, right? Huge economies of scale. How many of you realize that in today's world, the strong get stronger? Strong companies get stronger. And it's a winner take all. Okay? It's the winner take all. That's why there's no way that Snapchat can compete with Facebook or Instagram, because they spend hundreds of billions on AI infrastructure. They create that economies of scale that no one can replicate. Understand? Number three is high growth potential. Okay. So let me ask you this question. Would you invest in childcare centers in Singapore? Like there's this company called Mind Champs that does childcare centers, right? Would you invest in childcare centers in Singapore, in Japan, in US, in China? Yes or no? Of course not. Why? Why not? Because it's a declining industry, right? Because the birth rate is falling every year. There's less and less babies being born. So no matter how hard you want to grow the business cannot grow because there's less and less customers every year. You're going against the current, understand? But would you invest in old age homes? Would you invest in medical facilities in Singapore, US, China, Japan? Yes, because it's a what? Growth industry because of the aging population, correct? So if you look at all the companies I invest in companies within high growth industries like healthcare, like cybersecurity, like AI infrastructure. Okay? These are the secular growth. Many years ago, I used to own a company called Boston Beer, and I sold it. And there's another company called Constellation Brands that owns a lot of alcohol stocks that Buffett still owns it. I don't know why he still holds it. But is it a good idea to own alcohol companies today? It's a bad idea. Why? Because globally, people are drinking less alcohol, right? The new generation, they drink less alcohol than the previous generation. So it's a declining industry. You understand? But if you invest in companies that focus on healthy drinks like Celsius, is that a growth industry? Yes or no? That's a growth industry. Understand? Yeah. Okay, next, very important. Make sure that the companies you buy, okay, they have got conservative debt. Okay, I like to buy companies with very little debt and a lot of cash. Why? If you look at companies in the past that went bust, like Lehman Brothers, like Silicon Valley Bank, like High Flux, like Nobel Group, what did they all have in common? What did they all have in common? They all had unsustainable debt. So when a company has got very high debt, the moment there's a recession, the moment there's a financial crisis, they have the risk of going bust. They drop, they never come back. But if you buy companies with no debt or little debt, in the worst recession, they will be fine. In fact, they are able to buy up a lot of the competition. Understand? Like recently, a lot of people ask me about Oracle. Hey, Adam, you know Oracle stock, should I invest in Oracle stock? Now, I don't know about you, but I wouldn't dare to touch Oracle stock. Why? Why wouldn't I dare to touch Oracle stock? Let me show you why it's very scary for me to invest in Oracle. Why? What do you think is the problem with Oracle stock? The debt is very, very dangerous. Look at that. The financial strength is very low. They've got very low financial strength. Look at that. Now, to be specific, let me show you the data here. Their debt servicing ratio, okay, this one is still not so bad. Their debt to EBITDA ratio is 3.85. Sorry, this is the average. This is the latest one. The latest one is 3.94. This is dangerous. This is very dangerous, okay? the debt to EBITDA ratio cannot be more than 3. It cannot be more than 3. If it goes more than 3, it's getting very dangerous. Understand? Now, you guys remember high flux? Do you know what was high flux debt to EBITDA ratio? It was freaking 12. Nobel Group, debt to EBITDA was freaking 15. It was insane. That's why that time I told my students, I say that you buy these two companies is very dangerous. And eventually they both collapse. So you got to watch the debt to EBITDA ratio. This one must be less than 3. Debt servicing ratio, this one must be less than 30%. Interest coverage ratio, this one at least 4 to 5 times. Okay, so you have to look at all these things. Understand? Okay. Now again, there are a lot more criteria I look at, like return on equity, return on invested capital. I look at cash conversion cycle. I look at accounts receivables. And I can't go through everything today because there's a lot more to cover. But today I've got less than 3 hours. In fact, I've got only half an hour left. So I'm talking very fast because I want to teach you as much as I can today. But there's a limit to how much I can cram in 3 hours. Do you know it's really about 2.5 hours? Sorry, it's about 2 hours, 15 minutes. Okay. How do you find that what you've learned so far is useful? How do you find that if you can apply what you've learned, it can transform your investment results? And how do you find that you now realize some of the mistakes you've made in the past? Cool. Great. So again, today, I want to share with you as much as I can, but today I can only cover less than 3% of what you need to learn. That's why take the investing course, the whale investor course. Because in the whale investor course, you will learn everything. You will learn everything about how to invest. And once you learn everything about how to invest intelligently and safely, you have the confidence to manage your own money. And you have no more fear of recession. You have no more fear of market crash. You've got no more fear of what Trump will tweet. Because you know that no matter what happens in the short term, market goes up and down short term because of emotions and market manipulation, you don't care. Because if you hold good companies and you add only when they're undervalued, you will do very, very well over time. Your portfolio will compound and compound over time. Okay? So let me share with you a bit more. All right? Let me teach you guys a bit more. Now, like I said, we only want to focus on what? The top 1% of companies in the world. Okay? These are companies that consistently grow their revenue, profits, and cash flow. Correct? Remember, a business is a money-making machine. The more money it makes, the more it's worth. So good companies, over time, what will keep increasing? Good companies, over time, what will keep increasing? The intrinsic value, right? That will keep going up over time. The company will be worth more and more over time as they make more and more money over time. But will the share price go up in a straight line? Will the share price go up every day, every week, every month to reflect the value of the business exactly? No. So in the short term, the stock price doesn't always reflect the value of the business. The share price is driven by emotions, manipulation, and news. So sometimes in the short term, when there's good news, when there's manipulation, the share price can go way above the valuation. That is called like a bubble, right? Overpriced. But then when there's bad news, oh my God, Trump is imposing tariffs. Oh my God, there's another war. Oh my God, the Fed raising interest rates, right? Then the price can go, But then the cycle will repeat. Good news again. Oh, good news. Oh, bad news. Good news, bad news, good news, bad news, good news. And then recently, last few weeks, bad news. Okay? So what do we call this? We call this volatility. Now, as intelligent investors of great companies, do we like volatility? Do we like volatility? Yes, we love volatility because volatility creates what? It creates the temporary mispricing of the business. I repeat, write this down. Volatility creates the temporary mispricing of the business. That means a business that is worth, let's say, $500, okay, could temporarily be selling at $200 because of manipulation, because of panic. So this is when it gets under what? Value. Okay. But then a company that's worth 500, could it also sell at 800 sometimes because of hype, because of optimism? Yes. Then it is overvalued. So you tell me, as an intelligent investor, when is the safest time to buy shares? And which will give you the highest returns over time? Do you want to buy in area here? Let's call it area A. Or do you want to buy here? Let's call it area B. A or B, guys? All of you type B. Correct. You want to buy at area B. Now, that's what you say. But is that what you do? I hope, okay? Because most retail investors, 90% of retail investors who are not trained in investing, they always buy at A. And not only that, they always buy somewhere here, right near the top. Why? Because most retail investors, they buy and sell based on what? Emotions and reading news. So when they see the share price going up, going up, going up, going up, going up, going up, they say, wow, everyone make money. I want to make money. They got the fear of missing out, right? And that's when the company will show all the good news. Oh, the company is doing well, the revenue is growing, the profit is growing, and they get excited, they jump in. But by the time they buy, what happened? The price already went up. If everyone loves a company, that means it is overpriced, right? So they buy it there. And after they buy it, what happens? It may go up a bit more, right? But shortly later, it will drop. Then when it drops, everyone panic, everyone sell. When they see everyone sell, everyone panic, they also panic. And that's when the news will come out bad. Oh my God, Trump is having more tariffs, the interest rates are going up, and this and that. Yield curve inversion. Michael Burry said, they sell. So they end up selling here. So they buy high, sell low, buy high, sell low, buy high, sell low. How many of you have done this before? Every time you get excited, you buy a stock, it drop. After you sell, it go up again. How have you that happened to you before? Now, if that has happened to you before, it's not because you are unlucky. It's got nothing to do with luck. It's because you're like most people, you're buying and selling based on emotions and reading the stupid news, okay? So if you want to make money consistently, like me, right? Like my students, where we make, we beat the market consistently year after year, then you have to train yourself to go opposite of everyone else. So in other words, you only want to buy great companies. Listen carefully, you only want to buy great companies when they're undervalued. Now think about it. When is a great company undervalued? When there's good news or when there's bad news? That's right, when there's bad news. When there's bad news, you only want to buy a good company when there's bad news, because that's when you buy underpriced. Okay, and when is a company undervalued? When people are confident or people are fearful? Optimistic or fearful? Correct. So Warren Buffett has always said, be greedy when everyone is fearful. All right. Does this make sense, everyone? Now, so currently in the market now, are there great companies that are undervalued because of recent bad news? Yes. Okay. There are. So you want a few examples? Okay. Now, before that, let me answer this question. So some of you are asking, Adam, how do I, okay, by the way, sorry, let me just draw that again. Okay, sorry, let me just draw that again. So some of you are asking, Adam, how do I know what is the intrinsic value, right? That is the most important thing. Oh, by the way, let's look at the next thing over here. So let's look at Meta. Meta owns Facebook, they own Instagram, they own WhatsApp. And over time, you can see that their intrinsic value keeps going up. Why? Because they make more and more money over time, all right? And this is the time to buy. You want to buy when the share price is below the intrinsic value. This is the time to buy. 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 Now, this is the time to buy. You buy when it's below the green line. Now, two questions for you. Number one, is Meta a great business? Okay, that's the first question. Huh? Second question, how do you know what is the intrinsic value? Because once you know the intrinsic value, then you know when the price is below the intrinsic value. Then you know when it is selling cheap, right? Okay, so first question, how do we know it's a great business? Again, let's look at Meta. So what did I tell you earlier on? A great business has what? Number one, consistently growing revenue, profit, and cash flow, right? Okay, so if we look at the long-term financials, again, you can change to a bar chart, right? So is the revenue growing consistently, yes or no? Is the profit growing consistently, yes or no? Now, doesn't mean it goes up every year. Certain years it goes down. There are years it goes down, as long as it's on an uptrend. Free cash flow also consistently growing, right? What else did I say that makes a great business? What else did I say? It must have a wide economic moat. So if you go to Oracle IQ here, straight away it can analyze the moat. What's the moat? How strong is the moat of Meta? The moat is 8 out of 10. It's got one of the strongest moats in the world. All right? Where does the moat come from? Brand loyalty, 6 out of 10. Wait. Barriers to entry, 5 out of 10. Switching costs, 5 out of 10. Network effect, 10 out of 10. So this is the most important thing, the network effect, 10 out of 10. Okay? Economies of scale, 9 out of 10. So this gives a very strong moat. Financial strength, also very strong financially. All right? Very strong moat. Very profitable. Very predictable. Okay? Now, how do you calculate the intrinsic value? In the whale investor course, you're going to learn how to calculate the intrinsic value manually, right? Using our intrinsic value calculator. So when you purchase the whale investor course, later you can get it at a big discount. It comes with all these intrinsic value calculators, where you put in the free cash flow, you must normalize it. Okay, that means you need to take the average 5-year capex to normalize the capex. Okay, the total debt, the cash and investments, the projected growth rate, the shares outstanding, and you'll calculate what's the intrinsic value, $816. So what's the share price now? Now it's 594. 594. So right now it's selling at what? 27% discount to the intrinsic value. Is it a pretty good deal? Yeah, it's a pretty good deal, right? Right? It's selling 27% discount to the intrinsic value. Okay. So again, if we look at this chart over here, okay, right now it is selling at a discount. Okay. Now, can we always predict the exact bottom to buy? Can we always buy right at the bottom? Can we buy always right at the bottom? No one can predict the exact bottom. As long as it's below the green line and it goes to a support level, okay, that's when I will buy slowly, right? So for example, let's say this is the first support level, I buy a bit here. It dropped to the second support level, I buy a bit. Drop to the next support level, I buy a bit. Okay. So if you buy at support levels, your average price, let's say your average price is somewhere here. So you can't always buy at the bottom unless you're super lucky. Huh? But even if you buy somewhere here or somewhere here, will you do very well? You buy somewhere here. You buy somewhere here. You don't have to buy at the bottom. Would you? Yes, you do very well. So don't always think that I must buy the bottom. No one knows where the hell is the bottom. Okay. So if you look at Meta, okay, let me show you Meta. Okay. So the intrinsic value is about 815. Okay, that's the intrinsic value. Okay. So now it's selling at 594, right? And it's at a support level here. So these are what we call support levels. Okay. So in the whale investor course, I will teach you how to draw these support levels. These are where I will add slowly. Okay. And if you subscribe to the UIP, I will draw the support levels for you every month. So every month, all the great companies, I will update the support levels. I will update the intrinsic value. And so basically, you don't have to do the work. I do all the work for you. So people who want me to do all the work for them, they say, Adam, you cook for me. I just eat. Okay, then that is the ultimate investor's playbook. And that one, you also get to see what I buy and sell every day in the UIP subscription. Okay. So that's Meta. How about NVIDIA? What do you think about NVIDIA? Is NVIDIA cheap or expensive right now? Again, you can calculate the... Okay, first of all, is NVIDIA a great business or not? NVIDIA is, look at that, all ranked top, high predictability, high profitability. Look at that, fantastic. If you look at the financials, look at that. The revenue, the profits, the free cash flow. Very strong, right? And how about the moat? Is it a strong moat? Let's check the moat here. My God, this is 9 out of... This is 9 out of 10. Is one of the strongest moats in the world. This is a damn good company. But is it cheap? Is it cheap? Well, again, if you do the intrinsic value calculation, again, in the whale investor course, you will learn step by step how to key in all these numbers, how to key in all the numbers, and how to calculate the intrinsic value, $210. That's the valuation. What's the share price now? Share price is now 178. So it is slightly undervalued by 15%. Yeah, you can download this intrinsic value calculator once you enroll in the whale investor course. In a short while, I'll be telling you about the course. There's a 50-60% discount today on all the courses. All right. Now, if you're too lazy to calculate this yourself, I'm very lazy. I'm very lazy. How? Don't worry. In the UIP, I will value everything for you every month. I'll update the valuations as well as the buy levels. Okay. So if you look at Nvidia, what are my buy levels? These are my buy levels.
Thank you guys for watching. Don't forget to like, share, and subscribe. And looking forward to doing another video next week. Happy trading. Over and out.